The wealthy already know these 5 key reasons for investing in stocks, and they're laughing all the way to the bank. It's time for you to join in on the party, so stick around, especially to see number 5.
Let's get this party started.
I'm Jonathan, and we're talking 5 reasons to invest in stocks now in today's edition of Constant Cash Flow. I want to give a quick shout out to Andrew Pinto and 58 Sports Suburban, 2 recent subscribers before we dive in. Thanks for subscribing and watching. I really appreciate it. When most people talk about personal finance, they talk about budgeting and saving money. And these are extremely important foundations of a good personal finance strategy. But a more exciting point that makes a huge difference in your ability to retire early or build generational wealth is hands down investing. But why should you invest? And what makes it such a key factor in accelerating the success of your personal finances? Now we're going to jump right in with point number 1, which is passive income. Passive income is essentially income that you earn on a continuous basis based on work you've previously done. This is honestly the reason that I started with investing. I was tired of holding cash that was doing nothing for me and actually costing me money, as you'll see later. When I started investing, my entire world honestly changed. It gave me a different, more promising, and secure outlook on the future for myself and for my family.
I feel so free.
Good examples of passive income are, of course, investing, real estate, affiliate marketing, or owning something like an automatic car wash. There are many different types, but let's talk about why investing is one of the most hands-off. When you invest your money in the stock market, it's the company's responsibility to increase their earnings and profits so they can make their investors happy and continue to invest with them. If you've seen any of my videos, you know that I believe one of the most tangible ways to do this is through dividend investing. Where you put the money you save is extremely important, and there are many options out there. It can be a major factor in how quickly you build wealth and with what effort. For instance, if you're saving all of your money in a standard savings account, you could be earning around 0.06% per year. There are also high-yield savings accounts. I do keep some cash in a high-yield account for liquidity that earns 4% on the first $3,000 and 1% on any amount above that. And then there's the stock market that historically has averaged around a 9% return. To put that in perspective, let's look at what it means to $10,000 of savings over 20, 30, and 40 years. In the standard savings account, we would earn $6 in year number 1. After 20 years, we see our savings grow to $10,120. After 30 years, we'd added a total of $181 in interest, and in 40 years, we'd see our initial $10,000 investment reach a total of $10,242. That hurts me to even look at.
Is this a joke?
In our high-yield savings account, we'd earn 4% on the first $3,000 and 1% on any savings above that amount. We'd earn $190 in the first year and $4,183 after 20 years. In 30 years, we'd see a total return of $6,609. And in 40 years, we would see that our $10,000 investment has reached a total of $19,288. While that's definitely an improvement on a standard savings account, it's nothing to write home about. And last, by investing $10,000 in the stock market, we would see a $900 return in year 1, a $46,000 return after 20 years, and $122,000 after 30 years. In 40 years, we'd see our investment balloon to over $314,000 with an astronomical $304,000 return. Where do I sign? The second reason to start investing in stocks today is that it has the lowest barrier of entry of all investment types, and it's lower than ever right now. Gone are the days where it was necessary to go through a broker to make stock purchases. And gone are the days where you had to pay a transaction fee for every purchase. With investing apps like M1 Finance, Robinhood, Webull, and so many others, you can make investments easily from your phone or laptop with no transaction fees. And if you're looking to do that, at the end of this video, you can check out the links in the description to get you started with some free stocks and sign-up bonuses. When you compare stocks to another investment type, such as real estate, it's much easier to get started and with much less money. With real estate, you typically need to have around 20% available for a down payment. So for a $200,000 property, you'd need cash up front of around $40,000.
What am I, made of money?
While real estate's a great investment and can be very lucrative, the barrier of entry is extremely high. Now, let's take a look at the effect of compounding interest and the snowball effect. As you saw in the first examples I shared, your money will grow substantially when using the right investment vehicle. Compounding interest is basically the eighth wonder of the world. It magically turns a little bit of money, invested wisely, into a whole lot of cash. Even Albert Einstein is said to have called it one of the greatest mathematical concepts of our time. But you don't need to be a genius to harness the power of compounding interest. Trust me, this is so much easier than the theory of relativity.
Thank God.
When you save or invest, your money earns interest or appreciates. The next year, you earn interest on your original money and the interest from the first year. In the third year, you earn interest on your original money and the interest from the first 2 years, and on and on and on. It's like a snowball. Roll it down a snowy hill and it'll build on itself to get bigger and bigger. Before you know it, avalanche. That's what we call the snowball effect. To give an example that really shows the power of its use, imagine we have 3 people, all looking to retire by age 65. Andrew invests $1,000 per month from the ages of 25 to 35. Julie invests $1,000 per month from the ages of 35 to 45. And Jason invests $1,000 per month from the ages of 45 to 55. Even though all 3 people invested the same amount of money, which is $1,000 per month, over the same time period, 10 years, there's a significant difference in the end result due to the magic of compounding interest over time. At age 65, Andrew has $2.8 million. Julie has $1.2 million, and Jason $512,000. This should really stand out to the younger investors and make it clear that starting early can give you a huge boost to your long-term earnings. Time really gives you a significant advantage due to the power of compounding interest. Although it's never too late to start. If you can start in your 20s, you have a leg up on everybody else, and it will make things much easier for you in the long run. These years can make a life-changing difference in your investment. I know it's a little bit of a double-edged sword because earning power is typically lower in your early 20s, but even if you can set aside a small amount each month, you'll thank me later. But a simple like on this video will suffice. Another reason I love investing in the stock market is the ability to beat inflation. This becomes even more critical in today's economy. Inflation has averaged about 3% a year historically, and it's at 30-year record highs as of the recording of this video at just over 6% in the United States. So the prices of goods and services are typically increasing at about 3% per year. That means that the value of the dollar is decreasing every single year. If you have money sitting in a savings or checking account, you aren't combating inflation. You're literally burning cash. I don't know about you, but I worked way too hard for my money to set it on fire. And reason number 5 for investing in the market is for the tax incentives. Wealthy people use tax incentives all the time to hold on to their money, and there's absolutely no reason you can't or shouldn't do it too. First, let's talk about tax-deferred investments. These investments provide an upfront tax break. If you're eligible to participate in a company-sponsored 401k and they match up to a certain percentage, start there. It's an immediate 100% return on your investment. Traditional IRAs are also tax-deferred, albeit with no company match. You pay taxes on these investments only when you withdraw your money during retirement. Second, if you qualify to invest in a Roth IRA or a Roth 401k, that should be your next priority. Contributions to these plans are made with after-tax dollars, so you don't receive the same upfront tax break that you do with traditional IRAs and 401ks. However, your investments grow tax-free, and qualified withdrawals in retirement are tax-free as well. That's why these accounts are considered tax-exempt. If you're a long-term investor putting money away for retirement, there's yet another tax advantage. After holding an investment in the stock market for more than 1 year, any profits made from the sale of that investment are considered long-term capital gains. Federally speaking, long-term capital gains are taxed according to graduated thresholds for taxable income at 0%, 15%, or 20%. The tax rate on most taxpayers who report long-term capital gains is 15% or lower. Short-term capital gains, which are those made when holding the investment for less than 1 year, are taxed just like your ordinary income. That's up to 37% in 2021, depending on your tax bracket.
You have got to be kidding me.
At the federal level and under the current law, capital gains for a single person under $40,400 are essentially tax-free. $40,401 to $445,850 are taxed at 15%, and anything above that is taxed at 20%. For a married couple at the federal level, capital gains under $83,350 are tax-free. $83,351 to $517,200 are taxed at 15%, and anything higher at 20%. States tax capital gains differently, with some charging no taxes at all, and California charging the highest rates capped at 13.3%. Now, as you can see, there are so many reasons to jump in and start investing in stocks right now. We talked about passive income, low barrier of entry, compounding interest, beating inflation, and tax incentives. The sooner you start, the sooner you can start taking advantage of all of these benefits.
It's go time.
Thank you so much for sticking around to watch the entire video. I hope it provided some valuable information for you and helped you in your decision regarding investing in the stock market. As always, please do your own research before making any investments to see if it's a good fit for you, your goals, and your personal risk tolerance. Keep an eye out for my next video coming out in just a few days that gives you the inside track on how to retire a millionaire. Let me know in the comments what you thought about today's video and what you'd like to see discussed in future videos. I want to make sure that I'm putting out content that you want to see, and I really value your input. I'd appreciate it if you could leave a like and subscribe to the channel if this video helped you in any way. On the right, you can find more great videos to help you on your journey to constant cash flow. I hope you enjoyed today's video. See you next time.